So the Federal Reserve has finally admitted that inflation is indeed not transitory and that it has become a much more serious problem for our economy. And as a response to this, in their latest meetings minute report, the Feds announced their plans for 3 interest rate increases throughout this year, with the first expected at the start of the second quarter. But by far the worst part of this report was the fact that the Feds actually worsened their expectations for inflation while agreeing to taper asset purchases simultaneously while hiking their rates. And unsurprisingly, this caught every single high-growth tech stock by surprise and resulted in the worst week for the Nasdaq in almost a year. Warren Buffett himself said that interest rates act as a form of gravity for stocks, where the high valuation and unprofitable stocks slowly come back down to earth. High-growth stocks always tend to get their short end of the stick, but despite what the media says, there are still some solid growth stocks that can outperform in this high inflation environment. In this video, I'll be sharing 3 such stocks that can protect your portfolio from the pain that high interest rates will bring. I'm going to start off with the highest market cap stock and end the video off with the smallest market cap stock, so we have some strong diversity to hedge our portfolios from a potentially choppy 2022. But before we get into it, guys, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. The first stock up here we have is ticker symbol FB or Meta Platforms, and I think it's safe to say that this stock needs no introduction. Over 1 billion people have interacted with the products that this company sells, and chances are that every single one of you watching this video have used either WhatsApp, Instagram, or Facebook at some point in your life. And the reality is that these kinds of well-established businesses are exactly what's going to do well in a high interest rate environment. You see, when inflation is abnormally high, the cost of operating a company naturally goes up. And so to not lose a lot of money, companies need to often raise their prices, or in Meta's case, advertising charges, to offset the rising costs. But the problem is that companies with a lot of competition and no competitive advantages can't afford to increase their prices. And it's these companies that struggle in a high inflation environment. Meta Platforms has a lot of cash, a very high profit margin, and plenty of free cash flow, which is why this stock will likely do extremely well this year. Billions of people use Meta's apps every single day, and they're obviously not going anywhere. And since Meta stock has seriously lagged the big tech rally in 2021, it's only trading at a forward price to earnings ratio of around 23 bucks, which is much cheaper than stocks like Apple and Microsoft. And in my opinion, this incredibly well-established business model should only add to the upside of FB stock when investors rush out of the other overvalued stocks after the interest rate hikes. If we have a look at the Facebook stock chart, you can see that this stock has had one of the biggest bull rallies out of any stock over the past decade. And it's definitely for good reason, because this company has been innovating and acquiring other businesses at a very fast pace. For example, this company acquired Oculus and Instagram a couple of years ago, which is exactly what has paid off significantly for this company's shareholders. And obviously more recently, these guys have shifted their focus to the Metaverse, which is expected to be yet another very high growth industry for the next 10 years. But what really sets apart this stock from the other big cap stocks is the fact that this stock is actually trading at a very attractive price point. After having its big rally from around 250 bucks all the way up to 380 bucks, the stock has significantly pulled back to around 330 bucks. And as you guys can see on the weekly time frame, the RSI is trading around 50, which is exactly what tells me that this stock is in a very oversold and undervalued territory. And as you guys can see, it's also retracing back to its 50-week moving average, which has always acted as a very strong support zone from which the stock price has a history of running up. And I would not be surprised if we see a repeat of that this time around. I've personally been buying shares anything under 350 bucks on this stock, and I'm definitely looking for any good dip buys underneath $315. But overall, I'm very excited as to what Meta stock has in store this year. The next stock up here we have is ticker symbol COIN or Coinbase, which is a stock I'm sure all of you guys have heard of. It's safe to say that 2021 has been the year of the cryptocurrency, as we saw well-established cryptos like Bitcoin and Ethereum gain an insane amount of value. And on the other hand, we had new altcoins like Doge and Sheep come out and absolutely take the retail investor base by storm. And the fact of the matter is that Coinbase benefited from every single one of these crypto booms, and given how they've diversified into other blockchain applications like NFTs, this company will definitely hold a big chunk of its growth rates going into 2022 in my opinion. Generally speaking, Coinbase pulls in a ridiculous amount of profits, has very little debt, and has extremely low operating costs, which means that this company's future cash flow won't be too affected by rising interest rates. And sure, even though Coinbase stock might be affected by the volatile price of Bitcoin, that might turn out to be a positive thing. Because as we all know, one of the big purposes of crypto is to act as an inflation hedge, and since the Federal Reserve expects continued inflation this year, Coinbase can benefit very well. On top of this, similar to Meta, this stock is trading at a dirt cheap valuation with a forward price to earnings ratio of only around $17. If we have a look at the stock chart of Coinbase, you can see that after the IPO happened around $400 a share, the stock sold off very aggressively to around $200. But obviously, since this company is a cash flow machine, the stock rebounded very aggressively to hit a high of around $367. But obviously, over the past month or so, we've seen a big sell-off in crypto prices, and that has definitely taken a very big toll on Coinbase stock. But in my opinion, with the big inflation expectations for next year, paired with the fact that crypto prices generally don't directly correlate with Coinbase's revenue, is making a great investment opportunity in the stock right now. As you guys can see, the RSI is trading underneath 36, and the stock is coming down to this very strong support region around $225 a share. As you guys can see, whenever we have come down to that general price area, we've always seen some very good bounces to the upside. And as you guys can see, the 50-day moving average is sitting around $291, which definitely makes the risk to reward on this stock unmatched. I've personally been buying a lot of shares underneath $270 a share, and I would definitely not mind this stock going right back to that $200 support zone. Because at that price point, this stock should be trading at a forward PE of almost 15 or 14 bucks a share, which is exactly what you want to see if you want to invest in a high growth stock in an inflationary environment. Because as we all know, high valuation stocks are the ones that get hit very hard in a high interest rate environment, and Coinbase stock is definitely not one of them. The next stock up here we have is ticker symbol CRSR, or Corsair Gaming, which is by far the smallest market cap stock in this video, as it's trading at a price tag of only around $2 billion. But despite what many people might think, Corsair isn't as risky as some of the other high-flying small-cap stocks. You see, this stock is trading at a forward price-to-earnings ratio of only around $13 and has a current price-to-sales ratio of $1. What this basically means is that the market is valuing Corsair at the same level to its annual revenue, which is exactly why the stock can do very well in a high interest rate environment. Like I said, stocks with very high valuations and an inconsistent cash flow situation tend to get despised when interest rates go up. And since the S&P 500 is trading at a forward price to earnings ratio of well above $24 today, calling Corsair undervalued would be a massive understatement. But what really sets Corsair apart is the fact that it's taking part in an extremely sticky industry, which is the gaming and streaming industry. You see, when people buy products from Corsair, they tend to revert back to Corsair's products in the future, especially since this company sells a wide variety of computer hardware. These guys sell things like monitors, gaming PCs, mouses, keyboards, and microphones. And a direct result of this is that Corsair now has incredibly good cash flow on an annual basis. Their free cash flow was around $77 million in 2020, which is very impressive, especially since 2020 was such a tough year, especially in the first few quarters. And as we all know, companies had to work very hard to make sure they had the right cash available at the right time to fund their operations. But by far the best part is that these guys paid off a big chunk of their debt in 2021 as well, which will save them a lot of money from the high interest rates we'll be seeing this year. And this is exactly why companies that have a lot of debt on their balance sheet today are going to pay a big price over the next few years. And these low debt, high cash flow businesses like Corsair are exactly what investors will chase when the Fed tightens up its interest rates. If we have a look at Corsair's chart, you can see that this stock is actually relatively new to the stock market after they IPO'd in September of 2020. As you guys can clearly see, the IPO was a big hit as the stock ran up from around 14 bucks all the way to 50 bucks a share. But since then, we've seen an aggressive sell-off that has actually caught a lot of retail investors by surprise. As you guys can see, unfortunately, the stock had no major rallies in 2021 as basically it got shorted very aggressively every time it had a nice green day. As you guys can see, the stock has been in a very aggressive downtrend over the past few months especially, but now that we've formed this very nice base right around this $20 level, I expect some serious rebounding in the share price this year. Because as you guys can see, that is right where a gap was made in October of 2020, and as we all know, gaps always tend to get filled and they always tend to act as very strong support regions. So for me, I'm looking for any shares underneath 23 bucks a share, and I would definitely not mind seeing any pricing from around 17 bucks a share to around 19 bucks a share. Because like I said, the cash flow situation for this company and the company's balance sheet is top notch, which is exactly what I want to invest in when rates go up this year. But anyways guys, make sure to drop me a thumbs up if you found some value from this video. Let me know down in the comment section below your guys' thoughts on all the stocks that I mentioned in this video. And also feel free to let me know any stocks you guys are buying this year that can act as a good hedge for your portfolio in a high interest rate environment. But anyways guys, I hope you enjoyed this video and I'll catch you guys in the next one. Take care.